Hey everyone, welcome to the KE Report, a daily editorial on Friday, August 22nd, chatting with Rick Bensignor. Rick is the president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. And on the retail and individual side, check out the In the No Trader website. I'll post a link in the show notes. Rick has two products, a weekly report called the Tactical Trader and a daily report called the Daily Tip Sheet, all of which try to simplify market moves and take out a lot of the noise that comes along with a lot of other market commentary. Rick, it does seem like, look, markets continue to have this upward bias. I know this week markets were a bit slower, maybe a little bit mixed heading into everyone waiting to hear what Powell would have to say. And the market seemed to like what Powell had to say. It is a very short period of weakness as the markets are rebounding strongly. And quite frankly, the leadership right now doesn't seem to be the mega cap tech. We can even see today the Russell, the small caps, outperforming about by two times the S&P and the Nasdaq. So Rick, take us through this overall market environment. Is this simply just a bull market where dips simply need to be bought?
Well, for now, the answer is yes, Corey. Nothing's proven otherwise. We've not had more than a few percent pullback at any point since the April low. Not in the S&P. The Nasdaq had one 5.5% pullback. Also in April, after the low was made. Spiders have not. And when you get news like you got today, it looks like we're most likely going to head higher. Spiders probably get next to the upper 660s from the current 645-ish or so. So another, let's say, 20 to 25 spider points, which is 250 S&P points before we potentially hit a different resistance level. And some people might say, how do you know where resistance is if you're on all-time highs? But if you know what you're doing with charting, there's certainly ways to anticipate and project price targets even when things are on all-time highs. And think about last summer when I told, we spoke on your show and spiders were trading like at 550, and that was the all-time high at the point. And I said 609 would be a huge level where you want to reduce holdings, and that ended up being just about the high in February before we sold off 20%. So I'm going to tell you, on a short-term basis, 669 would be kind of the next trading target for the spiders, and in a bigger sense, I would say kind of like 747 is the next bigger major upside target for spiders. So that's still 100 points higher. So that's what, 1,000 S&P points higher.
Well, Rick, within the different ETFs and sectors that you follow, are you noticing any changes as far as we mentioned at the onset that some of the mega cap tech hasn't been the only game in town? Are you noticing any shuffling within the different weightings within the ETFs that you follow?
Yeah, so there's always shuffling, there's always sector rotation. It's a fact of how the markets trade. Recently, it looked like defensives were starting to pick up some, let's say, interest from investors as Mag 7 and the three sectors that make up Mag 7 kind of were on pause. And then you get, what's going on like today, and that's going to put Mag 7 right back on. All Mag 7 names are higher today. And last I looked, I think all 11 sectors were up today. Let me just take a peek. Yep. So this is across the board. Let's see if so here's I'm just looking at, kind of the current returns on the day. And what's interesting is that materials are up twice what the S&P is. Industrials, a little less than twice. REITs are up kind of almost twice what the S&P is. And the big winner right now is consumer discretionary, and that's because Tesla is up so strongly today. But notice that out of the sectors I just talked about, only one of them is a Mag 7 related. So you're getting some broadening out and, let's say investing going into more than just the three sectors that the Mag 7 mega cap names are in. And you mentioned at the top of the show that the Russell was up more than twice. The Russell's been up almost every day, more than the S&P, is because of the belief that interest rates are heading lower, and that's good for small cap names. They can't afford most small cap companies cannot afford high interest rates. They don't have the financing and the backing the way larger companies can to handle the shifts in interest rates. But if you're finally getting interest rates heading lower, which the market clearly believes is coming and has for the last several weeks, not always at the same amount. I mean, I think it was less than 2 weeks ago, there was over a 95% chance of a rate cut. After yesterday, it was only, I don't know, I think 75% chance, but now it'll go right back up, probably close to 100% chance for September. No surprise that IWM is outperforming spiders and Qs.
Yeah, that is true. That's what a lot of people have been saying. Lower interest rates will help the small caps. But Rick, if we take a step back, again, there are just so many sectors doing well, not just domestically, also internationally. Dips have been relatively shallow and bought very quickly. It was a bit more weakness earlier on this year in March through the early part of April. But other than that, again, it's up and to the right for a lot of these charts. What about this concept of an everything bubble? Everything seems to be overinflated. Valuations are high in so many different sectors. Do we need a much longer drawn out correction here?
You don't have to have one in the immediate future, but at some point, what was earlier when Palantir was trading $190 2 weeks ago, it was trading at something like 90 times forward earnings, a ridiculous amount. And finally, the market, woke up to that, gave it a good, quick, stiff, over 20% correction in just over a week. And of course, today the market, Palantir is going to be up just like everything else is. But there are times that investors actually, or maybe it's smarter money, puts a halt to some of the silliness that happens. And when you take a stock from 190 down to 145 in, I don't know, 6, 7 trading sessions, you know, that's painful if you had gotten in anything near the high. Even where it is now, near 160, it's still an expensive stock, but it's gotten a cult-like following. It's been the best S&P 500 name this year. And personally for me, I mean, it's been one of my all-time, oh no, all-time's the wrong word, but over the last few years, I'm still long Palantir from $22 a share. I was a believer in the company when nobody did, and I had to sit for a while with it, but then, it's woken up and been a home run type of investment. So you're going to get these periods where things correct sharply out of nowhere, but it's the type of thing is it lasting or not? And until you get something that more meaningfully impacts investor psychology of the underlying bull strength that's there. And I just got off a half-hour interview with actually the largest Japanese news bureau. So we spoke quite a bit about this. Until you get a shift, either just in general because valuations have gotten too crazy, or in a way that hurts far more people, if the underlying economic related issues that percolate underneath, like below the scenes of the daily headlines of S&P makes new all-time high. Today the Dow's making a new all-time high. Spiders haven't quite yet, but the Dow did. So the public gets the message from the media constantly that all is well. But there's lots of stuff brewing underneath that suggests otherwise. So part of the discussion I just had with that Japanese news organization is that depending upon whom you ask how things are in life, you will get a very different answer. I responded by saying, look, and it just so happens that the reporter who was talking to me in conversation, she came out and mentioned where she lived. I said, wait, you're in the town immediately next to me. So we live north of Manhattan in generally what's considered, a comfortable economic area. I said, us talking about the markets and what percent of our life savings are invested in the market compared to if you ask somebody in the deep south. It's night and day. You know, it's the media presents as headline moving, everything's good, but we still have a $37 trillion debt, something like 15 to 20, I think it's 15 to 20 trillion needs to get refinanced in the next 45 days, give or take. The consumer debt is close to record highs again. The amount of margin money pushing the stock market up from individual investors is very high, and it continues to work until at some point it won't. There's not always as rosy a true environment as the stock market makes it look. And I think, one still needs to look at the potential risks down the road as compared to just listening to what the media presents as headline news and that, market's up on new highs again. Yeah, that's great, especially if you have a fair amount of your personal wealth invested in the market. I'd love to see a day like today, right? But that's not representation of most of America, and for that matter, most of the world. So I think you still need to look at within the context of this bull market that rips higher, what are the underlying risks and to what degree does that impact how much at any given time you want to either be putting in the market or taking some profits. I constantly take certain amount of profit when I get a big run in a name I've bought. I'll give you an example. A couple months ago, I had clients get into the ticker is TMO, Thermo Fisher Electro. It used to be a Thermo Fisher. I think it's now called Thermo Electron. And we got in the 420s. And I just sold some a couple days ago at 500, which was the high of the move for a move that just fell, I don't know, $15, $20, but it's almost right back there because of today's price action. But I had a reason to kind of hit a major target somewhere around 500, and it just wasn't a bad place to take something off. The fact that it's close to there now, I have to ask myself, do I want to put on the shares? I just, put them back on and go back to my full 100% position. We're literally trading $500 a share as we talk now, and this is exactly where I sold it like a week ago. Or am I just comfortable? I had reduced the holding by 40%. Am I just happy holding the other 60% for what hopefully is, a bigger move up over time? These are the things you have to ask. So many people are just buy and hold, but as the market goes up and up, the risks get greater too. And you have to ask yourself, how much am I just going to be, kind of buying and holding versus, and I'm not talking about trading per se, but if you could buy something at 425 and sell it a month or two later at $500, that's a heck of a return in such a short time. Kind of makes you think like sometimes when you're given a gift, you got to take it.
Well, it's a great point. I mean, there's also the tax ramification to short-term trading versus long-term trading. But when you
Doesn't
got that
matter.
big of a gain,
It
yeah,
doesn't matter.
you made some nice profit. So
Does not matter. You're going to pay taxes ultimately anyway. So to me, you don't, unless you're holding something 360 days and you need the extra 5 days to make it a long-term hold. So you might back off for a week. If I never let taxes influence what I'm doing, because if I'm buying something and I'm up against resistance, I think that resistance is going to hold, I'm going to take some profits. And if I pay taxes, I pay taxes.
yeah, it's nice to pay taxes when you've made a nice profit. But just thought I'd throw that in there because there are sometimes considerations if you're right on the cusp of that time frame, the 1 year versus not. But you brought up an interesting point there, Rick, about the disconnect between what we see in the economy and the economic news and what we may see in the markets. And sometimes there is a divergence there where underneath the surface, all the debt and all the different things you outlined don't maybe paint the same rosy picture that when you go look at the indexes like the NASDAQ or the S&P 500, But you brought up one other point, and I'd love to dig into this, and that's the valuations. People say the trite phrase, valuations don't matter till they matter. We hear that all the time. But there's points in time where you ask people, do you think it's overvalued? And the propensity of the markets and financial media is to always be bullish. There's that bullish bias under the surface because they're fully invested or at least have a lot of exposure. Do valuations actually matter anymore, or do we need to reset the way we look at them? Because when we were looking at Nvidia a year or two ago, I asked a guy point blank, it has a 200 PE ratio. There was a point in time where 20 seemed like a fair thing. Do you think it's overvalued? And he would not admit that Nvidia was overvalued at that PE ratio, and Nvidia priced forward sales and priced, like several metrics you looked at. And he said valuations don't matter till they matter. So are we in that kind of an environment, Rick, where valuations that we used to use, we should just throw out those college textbooks and just say we're in a new, brave new world?
Well, let me ask you, when the guy says valuations don't matter until they matter, how is he going to know when they matter and sell anything close to the top as compared to seeing something that has the valuation you were saying, see its price cut in half and go, ooh, I guess maybe it did matter. And now you're selling at, 50% of where it was when you said it didn't matter. To me, of course, valuation matters. That doesn't mean you can't get some very high price, multiple tech related type names. You're not going to see that in a Procter and Gamble, but you're going to see it in Palantirs and Nvidias and those type names. And they don't matter until some point they do. But you've got to also anticipate and have the tools at your disposal to help figure out when they're going to matter. To me, somebody who says that it's kind of, now I don't know this person, I don't want to know who this person is, but to me it's kind of almost an ignorant statement to make because they don't matter until they do. What's that even mean in real life terms of investing in the market? If you say they do or they did, it's only because something just got completely shaven in price. And I rather look at where's something really stretched and potentially from either the timing models I use or other ways of measuring upside targets that you can say something is so stretched here, it's got a crazy valuation and the timing's right for this thing to stop, that you take some off the table, or you sell some covered calls, or you do something that's defensive to take advantage of how ridiculously priced certain items get. Now, I'm going to say something to you, which is most investors do not have the tools to be able to do this. So for them, if they bought an NVIDIA, and we'll pick that name because it was the darling, of the last year and the last few years, and since it, really made its move up, then you stick with it if you're a long-term believer in what they do, and you deal with the fact that, the stock can go from 150 to 85 like it did earlier this year, where, it's not quite a 50% haircut, but it was probably in the neighborhoods of 40%. And you just deal with it if you think that you're holding this another 5, 10, 20, or 30 years. I grew up on Wall Street. I've been a trader from day one. My first job out of college was, on the commodities exchange floor. And I ultimately ended up trading 12 years in the commodities pits. I am a trader at heart. And to some degree, that may negatively impact my long-term returns because I end up selling out of something that, might be right for a month, but ultimately was wrong for the long term. And at the same time, when we get these market pullbacks, I'm far less exposed than most people are because I've learned how and when to take profits using models that are institutionally oriented models that the public generally has no idea even exists. And they don't show up in textbooks on how to trade or technical analysis textbooks. But this is, this is how some of the most successful hedge funds in the world learn how and when to reduce exposure when, the public still looks like they're buying and what we call smart money is actually selling to them. And then all of a sudden, boom, this thing takes a 30% dive. So it really depends on your time frame, your risk tolerance. There's lots of factors involved. But to me, when you say valuations don't matter until they do, anyone who says that to me has got to be someone who has no idea how to guesstimate when something is so overvalued that it's actually time to lighten up, even if it means paying taxes and then go buy it back 20, 30, 40% lower.
I find NVIDIA such an interesting case study because, yes, its PE ratio exploded. I guess investors were looking at the future growth it was going to have because even though NVIDIA is near all-time highs, I'm seeing its PE ratios right now, a trailing PE ratio of 56. Still, that is high. Its forward PE ratio 40, but it has come down from those triple-digit numbers. But again, it's at all-time highs. So it's one of those things that you can look at a point in time, but when you're judging some of these potentially explosive growth stocks, it brings up the question, and I guess more broadly, even when you're analyzing any stocks, what are some of the key metrics you pay attention to? Because I feel like we can always pick certain data points and say, well, this one's an outlier, this one doesn't make sense. But is there anything on a consistent basis that you really pay attention to, Rick, to gauge valuations and if something has gotten, let's say, too extended or quite frankly is just so unloved that it doesn't make sense either?
Well, yeah, there. I mean, look, I use a combination of models, again, that generally aren't in the public's hands, that like one of my favorite models I learned literally 30 years ago was 1995. I got exposed to it when I was kind of a junior person at Morgan Stanley. And it was my first job after leaving the trading floor. So, 12 years in the commodity pits and then, or 10 years, I can't remember, but something like that. And then I was able to get a job at Morgan Stanley in the commodity division. And somebody introduced me to a model and said, I think this is right up your alley. And the model was created by a man named Tom DeMark, and it is a very institutionally followed model that helps time when a stock or an ETF, let's just call it some tradable security, is likely at an exhaustion point of a current trend. And that's in either direction. So, part of how I bought, we were talking about TMO before, part of how I bought that had to do with that model. It was just one of three reasons I got in where I did. Just last week, I recommended to my clients in print, so it was, an official recommendation, got into Newsmax, NMAX, on, I think it was the day before it made its all-time low. So this thing IPO'd, went to, I don't know, 200 something, whatever, a day or two after its IPO, and was trading at 12 bucks. And, this model, this particular Tom DeMark model, suggested that it had likely exhausted itself to the downside. And it was the first signal it had gotten in the entire decline from all-time highs. And I told my clients this is a risky trade, but the risk reward is favorable. And like yesterday, and the stock hasn't done much since we got in until yesterday when the stock was up 15%. And so it's those type things where any prior buyer has been wrong up until the day before it made its, I recommended it one day before it made its new all-time low, and now it's significantly, it's probably close to 20% above that intraday low. It's those type things where if you've got the right models, the right timing for everything, that it makes sense to use that model at a particular time and place. And only part of that comes from the 40 plus years of experience I have being in the markets. Other people could use the same model and not be as successful as I've been with it. It's those type things where it's literally my background in behavioral finance, to having been a trader in the pit, to having been a strategist at Morgan Stanley and other companies, and having also helped run a book. So I've been officially on Wall Street in my 40 plus year career. I've been a commodities pit trader. I've been a sell side strategist, and I've been a buy side co-manager of a fund. I've worn the three major hats you can wear on Wall Street, and it's understanding the different roles that each one of those come with, the stresses and the pain points, and why and when and where portfolio managers make the decisions they do, whether for good or the terrible ones they often make. It's understanding that and being able to game those from both experience and, again, the behavioral finance background I have that lets me, suggest buying things where I do or selling things that everybody loves. And it ends up, I sell it within 3% of an all-time high, and then boom, it falls 10, 15, 20%.
Rick, with the experience you have in the behavioral psychology side of trading and the decades of experience that you have in wearing all those different hats, do you find that some of the models hold up better on maybe less of a narrative stock? Like when we talk about the Nvidias or the Palantirs or Tesla, they have such a huge kind of cult following and propensity to do things that just shock the market. Do you find that a stock like Walmart or Procter and Gamble, or like our Coca-Cola, like a consumer staple, may have a different correlation with some of the models than, say, a trending narrative stock that seems to defy gravity at times?
I'll tell you that in general, and again, I've been playing with this and using this model for 30 years now. It's pretty darn consistent. Now, does it have false signals? Sure it does. But part of the skill is knowing for any indicator you use when it's likely to work and when it's not likely to work. And you can't always get that right. And there are times I buy something that falls more, sure. But I think in general, you'd be hard pressed to find someone who's as consistent as I am at buying near the lows and selling near the highs, simply because of, again, the experience and the fact that I've used this model for, I may look at a weekly chart, which is obviously a full medium term to longer term perspective on the market, and take a signal that works, and I can use the exact same model and trade S&P futures on a 5-minute chart and be successful. That and I've written about this before. That's how robust this model is. It's the math behind it's not complicated. The implementation, the successful implementation of it is far more difficult. So it's not hard to explain the math of the model and how it comes up with the signals. Again, pulling off how and when to use it and when not to use it. And I'll give you an example. In the late 1990s, this model kept on saying upside exhaustion to, let's just call it, whether the spiders or the NASDAQ. This was the tech, in the midst of the tech bubble, and technology was the new forefront of, stock investing, and things just kept ripping to the upside. And this model on a daily chart kept printing signals of exhaustion. And it'd be right for a day or two, but wrong a week later. And it's been doing it again in the S&P. Let's see, probably for the last 2 months. So if the market bottomed in April and we're now in August, so I'd say, kind of starting maybe in June, it started showing some upside exhaustion on the daily chart. But it took longer for that same model to show up on the weekly chart. And even now, I think last week, you had a signal of potential upside exhaustion. And what I've written clients is when you get these rolling signals that just don't work, you realize just how strong this market is. And you don't generally want to fight it, but at the same time, you do have to still pay attention and know they're there, which means the market is more vulnerable at any given time for some drawdown than it would if these signals weren't there. And so what's that do net net? It keeps me putting almost every recommendation I put out is a buy in right now. And I can't say that's, in the winter, I was putting out far more short ideas than I am now because I've seen this before. This to me is kind of a replica of the late 1990s, where you just get these upside exhaustion signals that don't pan out. And so I've learned, you know, avoid going short and carefully choose what type names you go long. And I still am more apt to buy names that have been beaten up than I am to buy names that are flying because the upside to me makes more sense. But I still use this. If I'm trading or looking to enter a name, I'm using this model, let's say on a short-term basis, could be even a 30-minute or 15-minute chart to help try to time when to get into something I've already decided I don't want to buy. And so to me, because I've used these models over several decades, I find that with the experience of knowing when they work and when they tend not to, you have a far better edge than simply just buying because some person on business television tells you, what their final trade of the day is. Those, by the way, the records on those are terrible. And it's all part of the game of, do you care if you're buying a stock, let's just say $80 or $85? I do. Some people would say it doesn't matter if you're going to hold it for 10 years. And they're probably right. But I grew up in this business and I don't need to get the penny right, but I don't want to give up 5% for no reason, just, well, for no reason. So I'm a little more price sensitive than most, but that's my background and who I am.
Rick, I find this all so interesting. And I guess big picture sense with just how bullish these markets have been and how shallow dips have been. And even when we do have big dips, how quickly it seems like the Fed, other central banks, and the government broadly steps into these markets. Also considering the role of retail investors now that really seem to carry more weight in these markets and the, I guess, nature of investors right now more so chasing stocks, chasing growth than yield or buying treasuries or any sort of safety bonds. Have markets changed? They obviously always change, but have we seen a fundamental shift here where there's a reason to be bullish because the world is bullish, retail is bullish, and they simply have more access to the markets right now?
Well, there's several factors at play. Let's go to one of the most basic. Years ago, if you wanted to buy 100 shares of stock XYZ, it cost you probably in the neighborhoods of $100 through your broker. And this is 1980s. Now you buy for nothing. And it allows for much more in and out and trading and interest in the market because you had to think twice about spending $100 to get in and out of something. Now you do it for nothing. Obviously, the cost is built in other ways. And the companies you're trading through, whether Schwab, Fidelity, Interactive Brokers, doesn't matter, wherever it is, they're getting paid by the firms who are executing for order flow. So they've made up the commission that they used to charge individuals and get paid a different way. But that has provided tremendous access to markets that 20, 30 years ago was a whole different story. That's number one. Number two, up until 2020, interest rates were so low that people weren't really buying bonds a heck of a lot at that point because nobody wanted to lock in a 10-year for 1%. And I've been telling clients since then that you don't want to be owning bonds or buying them until rates move well higher because that is the likely direction of rates over the next several years. Now, you may have a Fed who finally, eases and takes back some of the hawkish moves they've made in the past. But if you look at a long-term bond chart, so let's go to the peak in yields in 1980 when a 10-year was probably getting, I don't know, 14%. And back then, that was not the benchmark. It was the US 20-year was the benchmark bond, and that was getting, I don't know, 18%, something in that neighborhoods. And then that goes all the way down to almost zero, right? The low is what, 40 basis points was the lowest low in 2020 for a US 10-year. The long-term equilibrium is still higher rates than where they are now. So even if the Fed eases and you get even 100 basis points pullback in the 10-year, I don't think these are good long-term investments any longer. The bond market of the past is done with. And when you see what the annual returns are in the stock market in some years, and you have a choice of that or collecting 4% guaranteed, most people, maybe not the age of 70, but most people 25, 35, 45, 55 years old are going to say, I'll take the risk of the stock market. So there's far more interest in investing in stocks and having your money there than the bond market. The old 60-40, I think, again, unless you're near retirement age or in retirement, why would you want to have 40% of your money tied up in a bond market that most likely over time you would lose money holding those bonds because you would see capital depreciation in the price of the bonds. So it might be okay for the near term with the Fed potentially easing. And of course, the Fed only eases the short end of the curve. The inverted yield curve that we saw 6 months ago is gone. And you're back to a normal curve and you're getting, paid more interest the farther out you go in the curve, which is the way it should be in a typical, normal, healthy economy. I'm just not a big fan of putting a lot of money in the bond market. And therefore, when you look at it in terms of what's your return going to be over time, I think this, you talk about old term, or the old time days over. I think so. I think 60-40 is not the right allocation, and it's probably more 70-30 minimum, if not 80-20, depending upon what your age is. If you're a 30-year-old, I would never tell you to put money in the bond market at this point. You have a 40 plus year investing time horizon. You don't need to be conservative. Doesn't matter if for 5 years the market sells off. There's no place you're going to make the money that you can. Let's take crypto out of it just because of the speculative nature of it. Than you will in holding stocks over time. So 60-40, 70-30 might be okay if you're 60 or older. But if you're listening to this and you're kind of in your youth, you should be virtually 100% in stocks or darn close to it, especially for your RIA and that type stuff.
Well, Rick, I'm glad you brought this up. I was actually going to ask you about, is the 60-40 dead? Because a lot of people have come on the show and mentioned they believe that the bond market is in a, not just a multi-year, but possibly a decade or two downtrend after a 40-year uptrend from 80 to 2020. So if that's the case, that money used to be considered the quote unquote safe money as a hedge against, the volatility in stocks. But if people go 100% in stocks or something to that effect, or maybe just a lot smaller portion of bonds, is there any other area that would pick up the slack and become that safe haven within their portfolio? Would they be using dividend stocks? Would they be using gold? Would they be using some other asset class to anchor their portfolio against the volatility of stocks?
I think the answer is everything you just said. Yes, some money in gold, and as high as gold is, I still think it goes higher over time. If you're going to play in crypto, it's very speculative, but if you want to put a few percent of, your entire portfolio there, I don't have a problem with it. I would probably stick more with Bitcoin than the other ones, simply because of the supply of Bitcoin compared to some of these other ones, which are really the greater fool theory type of thing. So look, 2 years ago when we spoke, I told you I wasn't a fan of crypto and I wouldn't put money into it. I've since put some money in. I'm long Bitcoin well lower than where it is now. So I probably doubled my money in Bitcoin, but still as a percent of my portfolio, it's quite small. And I have a dear friend who's got probably 40% of his total assets in crypto and is killing it. I don't want that risk. I can't deal with staring at 50% drawdowns, with any constant manner. And that's kind of, some of the risks you have to take there. Alternative assets, belong as a piece. So let's say you don't do 100% because I'm not saying literally just put money in stocks and nothing else. But I guess my message there is pay far less attention to the bond market. You can have some money in cash. I wouldn't tie it up into a bond market, but if you're getting 4%, or maybe it may get cut to 3.5%, while you're figuring out what to do with that money in something else, that's fine. But I don't want to lock that up for 10 years, so I wouldn't do it in the bond. I'd go on the short end of the curve and keep things fairly liquid. Even, if you have a Schwab account or a Fidelity account, you're probably getting 3.5 or 4% in their money markets. So that's fine to keep some cash in. Gold, maybe a little crypto. I think we're getting closer to the forefront of the development of new ETFs that'll be investing in like private equity. And I think you could always put a little money into that. But I think in general, again, depending, age dependent, your best returns are going to come from stocks. And yes, there'll be some swings. But if you're a 30-year-old person who literally has a 40 plus year time horizon, I would say just put money every month into your 401k. And probably the best things to do are Qs and spiders, maybe 10% in Russell, just in case you ever get a period of time that small caps really do outperform. They don't, they're not terrible, they're just major underperformers over time. But I would do something like that and not worry about bonds. And again, if your company allows some flexibility into what you can invest in, and there is some chance to do, an ETF like IBIT, a crypto, a Bitcoin related, sure, do a little in there too. But I would pretty much stay away from bonds if you're anything under the age of 50.
Very interesting, Rick. This has been quite enlightening and I think a useful conversation just to discuss what the markets are like these days. Sometimes we do always look back to history and say history rhymes or it repeats itself, but markets also do change and adapt to different narratives and different changes, really, in terms of what investors are interested in and also the access that people have to these markets, especially now with these Robinhood accounts and other such things. And you even brought up the private markets. That's a whole other discussion right now with how much money is in the private markets. Just look at what the private markets have been able to do just funding AI, especially ChatGPT and the company behind that. Rick, we're going to wrap it up here. Again, Rick Bensignor, president of Bensignor Investment Strategies. Click the link in the show notes to visit the In the Know Trader website, where you can find out more about Rick's retail and individual investment products. Great chatting with you as always, Rick, and everyone listening. Please be sure to check out the weekend show. This weekend, we're focusing also on broad markets in the energy sector and all the company updates that we recorded throughout the week on our website, podcast, YouTube channel, and Substack account. Just search the KE Report. Rick, thanks again for your time. Hope you have a great weekend.
You too. Thanks for having me.